TSMC just delivered an extraordinary second quarter of fiscal 2026, reporting $40.2 billion in revenue, up 12% quarter-over-quarter and nearly 34% year-over-year in US dollar terms, reaching the top of management's guidance range. High-performance computing generated approximately $26.5 billion, surging 20% in a single quarter and accounting for 66% of total revenue. Smartphone contributed roughly $8.8 billion, but declined 4% sequentially, confirming that AI infrastructure has become the company's dominant growth engine. Gross profit reached $27.2 billion, lifting gross margin to a record 67.7%. Operating income climbed to $24.3 billion, representing a 60.3% operating margin. Net income increased more than 77% year-over-year to $22.4 billion, equal to 55.6% of revenue. Earnings per share reached $4.22 versus a $3.81 Wall Street estimate, producing a powerful 10.8% beat. TSMC is converting the AI investment cycle into record profitability and the financial strength required to defend its technological leadership. TSMC's platform mix has undergone a structural reset. Since Q2 2021, high-performance computing has compounded at roughly 39% annually, turning from one major business line into the company's dominant growth engine. The decisive break came during the 2023 smartphone inventory correction. Consumer demand weakened just as investment in AI accelerators, data centers, networking processors, and custom cloud silicon began accelerating. From that point, high-performance computing pulled away and never looked back. It now generates approximately $26.5 billion, nearly 3 times smartphone revenue of $8.8 billion. That shift has moved TSMC deeper into advanced process nodes, complex packaging, and the highest value silicon in the industry. AI did not simply add another source of growth. It became the economic center of TSMC. TSMC has become the manufacturing backbone of global AI infrastructure. Advanced technologies at 7 nanometer and below now account for 77% of wafer revenue, with 3 nanometer and 5 nanometer contributing 63% combined. High-performance computing represents 66% of total revenue, while smartphone has fallen to 22%. Automotive remains smaller, but advanced 15% quarter-over-quarter. The opportunity now extends beyond the central processor. Modern AI accelerators combine leading-edge logic, high-bandwidth memory, chiplets, interposers, substrates, and advanced packaging. That makes CoWoS one of the most valuable bottlenecks in the semiconductor supply chain. TSMC is expanding packaging capacity because every new generation requires more memory integration, larger package sizes, and higher bandwidth. The company enters this expansion with approximately $110 billion in cash and marketable securities, a 67.7% gross margin, and a 60.3% operating margin. But leadership is becoming more expensive. TSMC raised 2026 capital expenditure guidance to between $60 billion and $64 billion, with 70% to 80% directed toward advanced process technologies and 10% to 20% toward advanced packaging and related capacity. Full-year revenue growth guidance now stands slightly above 40% in US dollar terms. Demand remains exceptional. The real challenge is scaling into packaging and global capacity without sacrificing the profitability that finances the entire expansion. TSMC's pricing power begins with the rapid migration toward advanced process technology. 3 nanometer generated 30% of wafer revenue, while 5 nanometer contributed another 33%. 7 nanometer added 11%, and 2 nanometer already accounted for 3% as commercial production began to scale. Together, technologies at 7 nanometer and below now represent 77% of wafer revenue, compared with 47% in Q2 2023. In dollar terms, advanced node revenue expanded from approximately $7.4 billion to $30.6 billion per quarter. 5 nanometer generated roughly $13.3 billion, while 3 nanometer contributed another $12.1 billion. Customers are not simply purchasing wafer capacity. They are paying for reliable yields, higher performance, lower power consumption, packaging compatibility, and confidence that a costly design will enter volume production on schedule. At mature nodes, manufacturers compete heavily on price. At the leading edge, customers compete for access to proven execution. That difference allows TSMC to command premium pricing while funding the next generation of process technology. TSMC's dominance is built on manufacturing execution, not market share alone. The supplied industry estimates place the company near 70% of the global pure-play Foundry market, compared with roughly 7% for Samsung. They also suggest an early 2-nanometer yield near 80% for TSMC, versus approximately 55% for its closest rival. These figures are industry estimates rather than official disclosures, but the strategic gap is clear. N2 introduces TSMC's first nanosheet gate-all-around transistor architecture, delivering stronger electrical control, lower leakage, and better performance per watt. That is essential for AI processors, where electricity, cooling, and thermal density are becoming fundamental constraints. The supplied estimates place N2 wafer pricing near $30,000, while CoWoS capacity is approaching approximately 130,000 wafers per month. TSMC raised 2026 capital expenditure to between $60 billion and $64 billion. Around 70% to 80% will support advanced process technologies, while 10% to 20% will fund advanced packaging, testing, mask making, and related capacity. Better yields attract the largest customers. Higher volumes create more production data, accelerating the economics of the next node. TSMC is using today's profitability to make tomorrow's competitive gap even harder to close. TSMC's global expansion runs from west to east. The United States now carries its largest overseas commitment. TSMC's first Arizona fab has been in volume production since late 2024, and total planned U.S. investment has risen to $265 billion. The latest expansion adds several advanced logic fabs, packaging facilities, and a major research center. Moving into Europe, the Dresden joint venture with Bosch, Infineon, and NXP targets 40,000 wafers per month, with production planned for the end of 2027. Further east, Taiwan remains the command center. TSMC is building 13 leading-edge and advanced packaging fabs at home over the next several years, protecting its deepest engineering, supplier, and yield learning advantages. Japan follows through Kumamoto. The first fab entered volume production at the end of 2024, while the two-fab site is designed to exceed 100,000 wafers per month. Core technology stays anchored in Taiwan, while overseas capacity adds resilience, customer proximity, and political protection. TSMC's roadmap to 2035 extends far beyond conventional transistor scaling. N2 begins the transition from FinFET to nanosheet gate-all-around technology, targeting approximately 10% to 15% higher performance or 25% to 30% lower power compared with N3E. A16 follows in the second half of 2026 with Super Power Rail, TSMC's backside power delivery architecture. It targets another 8% to 10% performance gain or 15% to 20% lower power, while reducing routing congestion for demanding high-performance computing designs. A14 is scheduled for volume production in 2028, delivering up to 15% more performance or 30% lower power compared with N2. Beyond transistor scaling, CoWoS Silicon Photonics targets bandwidth density of 4 terabits per second per millimeter by 2030. Advanced stacking, complementary field effect transistors, and two-dimensional materials such as molybdenum disulfide could extend density when conventional silicon approaches its physical limits. Long-range industry scenarios estimate cumulative investment of approximately $705.6 billion by 2035, supporting around 590,000 wafers per month of sub-2 nanometer capacity. Those projections are not formal company guidance. TSMC's 2035 objective is a major science-based emissions reduction milestone, while full net zero emissions remain targeted for 2050. Future leadership will depend on solving computing density, data movement, global resilience, and energy availability at the same time. TSMC is increasing investment without losing financial discipline. Quarterly operating expenses rose from $1.8 billion in Q2 2022 to $3.1 billion in Q2 2026. Research and development increased from approximately $1.3 billion to $2.3 billion, representing a compound annual growth rate of 16.5%. Selling, general, and administrative expenses increased from $0.5 billion to $0.8 billion, compounding at 17.1%. Operating spending has nearly doubled, but revenue and profit expanded much faster. That gap is creating powerful operating leverage. TSMC continues funding process technology, advanced packaging, manufacturing tools, and yield improvement, while operating margin has moved beyond 60%. The company is spending more, but each dollar now supports a significantly larger earnings base. TSMC's net margin has completed an extraordinary recovery. Profitability fell toward 37% during the semiconductor downturn of 2023 as demand weakened and factory utilization declined. The reversal began when AI demand accelerated, advanced node volumes expanded, and the product mix shifted toward higher-value chips. Net margin then climbed through 43%, 46%, 48%, and 50% before reaching a record 56% in Q2 fiscal 2026. Over the same period, quarterly revenue increased from $18.2 billion to $40.2 billion, while net income rose from $8.1 billion to $22.4 billion. Revenue more than doubled, but net income expanded almost threefold. TSMC is not simply manufacturing more wafers. It is capturing substantially more economic value from every dollar of revenue. TSMC has built a remarkably consistent record of outperforming revenue expectations. Q2 fiscal 2026 extended that streak to 9 consecutive quarters, with revenue reaching $40.2 billion versus a $39.8 billion estimate. The beat itself was modest, but the underlying trajectory remains powerful. Wall Street now expects quarterly revenue to rise toward $53.8 billion by Q2 fiscal 2027, driven by AI accelerators, custom cloud silicon, advanced packaging, and the expansion of N2 production. TSMC is entering a much larger revenue cycle. But as expectations rise, every successful quarter also raises the standard the company must beat next. Earnings per share have been even stronger than revenue. TSMC exceeded expectations in 8 of the last 9 reported quarters, with Q2 fiscal 2026 delivering the largest surprise. Earnings per share reached $4.22 versus a $3.81 estimate, producing a 10.8% beat. That performance reflects more than revenue growth. A stronger product mix, premium pricing, improving yields, and high factory utilization are converting demand into profit at an exceptional rate. Wall Street now expects earnings per share to reach $5.21 by Q2 fiscal 2027. The key test is whether earnings can continue rising faster than depreciation, overseas expansion costs, and the investment required to maintain technological leadership. At the time of the supplied market snapshot, Wall Street remained overwhelmingly bullish on TSMC despite the rising cost of expansion. Among 47 analysts, 38 issued strong buy ratings, 8 recommended buying the stock, and only 1 maintained a hold rating. The average 12-month price target stood at $526.12, compared with a market price near $415.58, implying potential upside of approximately 26.6%. The forecast range extended from $430 to $650. The investment case rests on TSMC's leadership in advanced manufacturing, record profitability, approximately $110 billion in liquidity, and its central role in the global AI supply chain. The risks remain significant. Capital expenditure of between $60 billion and $64 billion increases the consequences of any demand forecasting error. Overseas factories carry higher costs, while the N2 ramp will add depreciation and temporary margin pressure. Export restrictions, cross-strait tensions, electricity and water availability, customer concentration, and construction delays also remain important risks. But the competitive position is exceptionally difficult to challenge. NVIDIA, AMD, Apple, Broadcom, and the largest cloud companies compete through different products, yet many rely on the same scarce foundation: TSMC's advanced process technology and packaging capacity. Unless a competitor can match its yield, scale, engineering expertise, customer trust, and execution, TSMC remains essential infrastructure for the global digital economy. The views expressed in this video are for informational purposes only and do not constitute investment advice. Thank you for watching. Please like, subscribe, and share this video with anyone following TSMC and the global AI infrastructure build-out.